Gold prices have seen a small dip in today's trading session, pulling back from recent highs. This movement has brought the precious metal to a very important price zone. Traders are now watching closely to see what happens next. The price is currently caught in a tight range, creating a moment of indecision in the market. Will buyers step in to push the price higher, or will sellers take control and drive it lower? The answer to this question depends on how gold reacts to the key price levels that are now being tested. This kind of price action is common, but it requires careful attention from anyone looking to trade. The most important area to watch right now is the support level between $3,342 and $3,350 per ounce. Support is like a floor for the price. It is an area where buyers have shown interest in the past, and they may decide to buy again. Think of it as a price zone where demand is strong enough to stop a decline. If gold holds above this level, it suggests that buyers are still in control. This support zone is significant because it has held firm during previous pullbacks, making it a reliable benchmark for the short-term trend. A successful defense of this area would be a positive sign for the metal. On the other side, we have a key resistance level. This is like a ceiling for the price, located between $3,375 and $3,380. Resistance is an area where sellers tend to become more active, preventing the price from moving higher. For gold to continue its upward journey, it must break convincingly above this zone. A failure to break this resistance would suggest that the selling pressure is still strong. This level is important because it marks the recent high point of the price action. Breaking it would signal that the bulls have overcome the recent selling and are ready to push for new highs. So, what should traders do? The current situation presents a clear choice. We are waiting for a signal. The price is squeezed between a strong floor and a tough ceiling. This consolidation cannot last forever. A breakout in either direction is likely to happen soon, therefore patience is key. Instead of guessing, it is better to wait for the market to show its hand. We need to see a clear move away from either the support or the resistance level. This will give us a better idea of the direction gold is likely to take for the rest of the day. Let's explore the bullish scenario, which is what happens if gold bounces from its current support. If the price reaches the 3,342 to 3,350 area and starts to turn higher, this is a strong signal for buyers. We would look for signs of buying pressure, such as the formation of bullish candlestick patterns on the chart. For example, a hammer or a bullish engulfing pattern near support would suggest that buyers are stepping in with force. This would indicate that the recent pullback was just a temporary pause in a larger uptrend, and the price is now ready to resume its climb. This is often seen as a good opportunity to enter a long position. If a bounce does occur, the first target for buyers will be the resistance level at 3,375 to 3,380. This is the first major obstacle on the way up. A successful move back to this level would confirm that the short-term momentum has shifted back to the upside. Traders who buy near support will likely aim to take some profits as the price approaches this resistance. However, if the buying momentum is very strong, the price might not even pause there. A strong move through this resistance would be a very bullish signal, suggesting that the market is ready to aim for much higher levels in the coming sessions. Beyond the initial resistance at 3,380, the next target for the bulls would be the psychological level of 3,400. Round numbers like this often act as magnets for price. A decisive break above 3,380 would open the door for a quick rally towards this next milestone. This would signify a continuation of the broader uptrend and could attract even more buyers into the market. Traders would see this as confirmation that the bullish trend is not only intact, but also gaining strength. The market sentiment would likely become very positive, supporting further gains for the precious metal. In summary, the bullish scenario depends entirely on the defense of the 3,342 to 3,350 support zone. A clear rejection of lower prices in this area, followed by a move upwards, is the key signal. Traders should look for confirmation from price action and momentum indicators. A bounce from this level offers a clear path towards the resistance at 3,375 to 3,380 and potentially higher. This setup provides a well-defined risk-to-reward opportunity, as a stop loss can be placed just below the support zone, limiting potential losses if the trade does not work out as planned. Now let's consider the opposite outcome, the bearish scenario. This situation unfolds if the price of gold fails to hold at the support level of 3,342 to 3,350. A break below this critical floor would be a significant bearish signal. It would tell us that sellers have overwhelmed the buyers and are now in control of the market's direction. A clean break, especially if it happens with strong volume, would suggest that the recent uptrend has ended. This would likely trigger more selling, as traders who were hoping for a bounce rush to close their positions to avoid further losses. If the 3,342 support level is broken, the first target for sellers would likely be the next area of potential support, around 3,320. This level might offer some temporary relief, as some buyers may see it as a new opportunity to get in at a lower price. However, the momentum would be firmly with the sellers at this point. Any bounce from 3,320 would probably be short-lived, and seen as an opportunity to sell at a better price. The overall market sentiment would have shifted from cautiously optimistic to clearly negative, putting downward pressure on the price. A break below 3,320 would be even more concerning for the bulls. It would open the path for a deeper correction, with the next major support level located near the 3,300 mark. This psychological level is very important. A drop to this price would confirm a more serious downturn and could signal the start of a new short-term downtrend. At this point, many trend-following traders would likely join the sellers, adding to the downward pressure. The market would be looking for a solid reason to stop the decline, and without one, the path of least resistance would be lower. In this bearish scenario, the key is the failure of the 3,342 support. A break below this level flips the immediate outlook from neutral to negative. Traders looking to profit from a decline would wait for a clear break, and then might enter a short position. Their stop loss would be placed just above the broken support, which now acts as resistance. This strategy allows traders to manage their risk effectively while positioning for a potential move down towards 3,320, and possibly even 3,300 if the selling pressure continues to build throughout the day. To help us decide whether a bounce or a break is more likely, we can look at technical indicators. One useful tool is the 50-period exponential moving average, or EMA 50, on the hourly chart. This indicator shows the average price over the last 50 hours and helps us see the short-term trend. Right now, the price is testing this EMA 50. If the price bounces firmly off the EMA 50, it acts as dynamic support and strengthens the bullish case. However, if the price closes below the EMA 50, it is a bearish signal that suggests the trend may be turning negative. Another important indicator is the Relative Strength Index, or RSI. The RSI measures the speed and change of price movements and tells us if an asset is overbought or oversold. Currently, the RSI is hovering around the 50 mark, which indicates neutrality and indecision. If the price bounces from support and the RSI starts climbing back above 50, it confirms growing bullish momentum. Conversely, if the price breaks support and the RSI falls below 50, and especially below 40, it confirms that bearish momentum is taking over. This provides a secondary clue to support our trading decisions. Beyond the charts, we must also pay attention to external factors. The value of the US dollar is a key driver for gold. A stronger dollar typically makes gold, which is priced in dollars, more expensive for buyers using other currencies, putting downward pressure on its price. In the next few hours, we are expecting some important US economic data releases. If this data is stronger than expected, it could boost the dollar and weigh on gold. On the other hand, weaker than expected data could weaken the dollar and provide a lift for the precious metal. Finally, the overall market risk sentiment is crucial. Gold is often seen as a safe haven asset. This means that during times of economic uncertainty or geopolitical tension, investors tend to buy gold for safety, pushing its price up. If the global stock markets are showing signs of weakness, or if there is any negative news, this could increase demand for gold. Therefore, keep an eye on the major stock indices and the general news flow. A combination of chart signals, indicator readings, and external drivers will give us the clearest picture of where gold is headed next.